What is up, everyone? So it's been about 2 months since I last uploaded my last video, and I really apologize for that. The last month I just wasn't uploading, and then the month before that I was in Bali for a month, and I'm really missing Bali right now. The weather here is just awful. It's cold and rainy, but yeah, I had a great time. Definitely glad to be back, and I'm definitely gonna start uploading more regularly. I'm going to shoot for 2 videos a week, and then if not, at the very least 1 video per week. And I'll go and show you a couple videos of my trip to Bali.
Hey.
Oh, he's so
You.
No way. No way.
Wait.
No way.
Definitely had a great time. Definitely wish I was still there. So yeah, to start it off, we're going to start it off with oil update. There's been a ton that's happened in the last 2 months in the oil market. Last week, oil has topped 85 bucks a barrel for Brent and 75 bucks a barrel for WTI. That's just huge news in the oil market. Oil stocks have been, depending on which ones you're in, they've been performing very well. Some of the stocks have still been really greatly underperforming oil. And I'm not mainly being like servicing stocks like OIH, XES, which are oil servicing companies, ETFs. Those have really been underperforming oil. Stocks like California Resources, ticker symbol CRC. I own that one. That one has been just crushing it the last year. A lot of Canadian oil names have really been underperforming. Stocks like GENGF is ticker, CVE, just really any oil name, BTE is another one, has really been underperforming. And that's due to there's a huge discount in Canadian oil prices. So what Canadian is priced in is WCS, Western Canadian Select, I think is what it stands for. And that is trading at about a $30 discount to WTI. So that's like, I think it's about 40 bucks a barrel. So it's trading at a huge discount. And you're probably wondering why it's trading at such a huge discount to WTI. That's due to pipeline constraints. There's simply not enough pipelines to get the oil from Canada down to the US and exporting out of the Gulf, basically. And they're having to ship a lot of that by rail, and that's still not enough. So basically, a lot of the oil that's being produced there, they can't do anything with it. It's just sitting there. That's why we're getting such a huge discount, and that's why a lot of these Canadian oil names are not moving one bit. Some of the offshore drilling names, such as Rig, ESV, Noble Energy, ticker symbol NE, those have been starting to perform pretty well. A lot of those have almost doubled in the last 6 months, and I expect that to continue if oil stays where it's at or even moves higher. So moving forward, where do I see oil prices going? Actually, short term, I'm somewhat bearish on oil. And then, medium to long term, I'm still very bullish. The reason being that I'm short term bearish, and I think it's gonna, at least take a dip to 70 bucks a barrel for WTI, if not more, is basically that Saudi Arabia and Russia have been pumping a lot more oil the last month, and basically they're going to continue doing that to basically offset Iran supply. They're not going to produce so much as to like flood the market again like they did back in 2014. But basically, Trump has been meeting with them. I think he's met with them several times. If you follow his tweets, you obviously know that he doesn't want oil anywhere near where it's at. But some things are above him, supply and demand, and a lot of these factors are really above what Trump can do. He can do his best to, minimize oil prices, but like I said, a lot of this is out of his control. And basically he's just delaying, the inevitable, the underinvestment in oil the last 4 years. He can delay that, but sooner or later it's going to show up, and the longer that it's delayed, the worse we're going to be. And last week the EIA actually reported a pretty big crude build in inventories. So inventories built by 8 million barrels for that week, which is fairly large. Usually we are starting to build around this time of year, but that's a pretty big build, and this was due to decreased exports. China has actually reduced taking our crude exports down to zero. That's down from about 500,000 barrels per day down to zero. So that really adds up. So right now in this chart, we are right on the 5-year average. We're sitting about 400 to 405 million barrels of oil in basically crude storage that we have. That's about the 5-year average. That's slightly inflated, from the excess years of 2014 to 2017. So we still have a little bit ways to go down to, the long-term 10-year average was 350 million barrels of oil in storage. If we get down to that level, I see $100 oil plus easy, just because we have such little spare capacity. Saudi Arabia is pumping at pretty much full tilt. Pretty much all of OPEC is producing everything that they can. They have no excess spare capacity. The only ones with spare capacity are, Iran and Venezuela. And those two have just been declining. Well, obviously Venezuela's been declining for the last year. That's due to just, political things in that country. Country's pretty much going to complete shit. And then Iran, that's due to the sanctions. November is when those go into full effect. And we're starting to see exports, fall off pretty significantly. So basically, Saudi Arabia, Russia, some of the other OPEC members are basically making up for that. So net, it's about even. All they're doing is making up for it. They're not increasing supply. As far as demand goes, it's still been, fairly healthy. Emerging markets have been hit very hard by Trump's trade deals, and that's really something to really look out for within the next 6 months to a year, is if that affects oil demand, because those economies have been hit very hard. A lot of their stock markets are down 10, 15, 20 plus percent in the last 6 months. And, if India and China, if their demand for oil, if their economy takes a hit, which China has already taken pretty big hits, their demand hasn't, gone down too much. Their demand growth, at least. All these countries their demand is growing, but their growth hasn't slowed yet, but that's definitely something to watch out for. And the last chart is days of supply. This is really almost a better metric than just overall crude storage, which we're at 405 million barrels of oil. So days of supply is pretty much almost back down to pre-2014 levels, which is about 22 to 23 days of supply. So basically, if everyone stopped producing oil tomorrow, we would have 23 days of supply. That's really a better metric, just because demand's gone from 85, 90 to in late 2018, 2019. I think we've already passed 100 million barrels. If not, we're going to in 2019. So obviously we're going to have more in inventory because we're consuming more every day. The numbers 400 million compared to what we had 350 million back in 2014. That's going to be last less because we consume more. So even though we're pretty far above where we were in pre-2014 for crude storage, days of supply is almost back down to those levels, and that's really the the metric that I look at almost even more so than just overall crude storage. So yeah, in summary, I'm short term not super bearish, just a little bit bearish. I think we're going to see a little bit of pullback. There's a lot of factors going into that. just that we've run up so much, and also we're getting a lot of news out that Saudi Arabia and Russia are increasing production, and that is, slightly bearish. They're not, coming out and going to flood the market, but they are increasing production, and that's going to have a cap on oil prices. And then, longer term, it really depends on how much oil we lose from Iran, on what oil prices do in the next 6 months to 1 year. Any sort of pullback, I'm going to look at, adding even more. Probably more so what I'm looking at now is offshore drilling names such as, Rig, Noble Energy, ESV. The Canadian oil names, they're still very discounted. I still like them. It's just there's no really development. The Canadian government is very, backwards and liberal. They don't want these oil pipelines going through their country for, whatever reason, environmental reasons. And that's going to keep a cap on Canadian oil prices. Like I said, right now it's at a huge discount to WTI. Expect that to remain pretty much constant. There are a lot of oil companies signing rail deals to transport their crude by rail. That'll reduce the spread a little bit. I think we could see a reduction in spread to $15, $18, but that's still a pretty big discount to WTI. So, that does put a pretty big cap on, some of these Canadian names. If pipelines ever do get built, but you're looking at like 2 years, 1 to 2 years at least for that to happen. So that's why you've seen names like California Resources, ticker symbol CRC, hugely outperform, Canadian oil stocks like GE and GF, CVE. Another American oil producer that produces heavy crude is DNR. That's really outperformed as well. There's some other bigger ones like APA, APC, WLL is another one. And that's why you've seen those, really outperform, a lot of other, Canadian oil stocks, and of course like majors like BP, Royal Dutch Shale. Those aren't going to move as much because they have, business in so many other segments. So yeah, that's it for this video, guys. I just want to give an update on the oil markets. I apologize for not uploading for the last 2 months. So from here on out, I'm going to be uploading at least once a week, and I'm going to shoot for 2 times a week, and kind of do 1 video a week, oil updates, and then another video, other various, finance topics, other sectors of the market. So yeah, that's it for this video, guys. Thanks for watching, and I'll see you guys in the next one.